There you can see the Dow Jones Industrial Average up only 68 points now. Was up more than 100, rebounding after yesterday's sell-off. You might be worrying. Look, everyone's always worrying, right? You always, oh my God, every time the market sells off, you think this is going to be the big one. Here it comes. We've kind of been conditioned to it over the past 12 years, really. But Jack Hough from Barron's is here with 5 reasons why the sell-off is not going to be big.
Yeah, well, who's to say whether a sell-off in a particular day is going to be big? But Paul, I've been worried about you. I've been worried that you would see stock prices reach new highs.
You worried about me?
Yeah, and then you'd say, hey, this is right back to the level we were in 2007 before the plunge, in 2000 before the plunge. So what's different now? What's different now?
What is different now?
So I want to give you 5 things. Okay. Right? First of all, you get more economic value when you're buying stocks. Earnings are up 18% since 2007, so you get more earnings for your money. And the book value of company assets is also higher. Stocks are about 20% cheaper relative to book value than they were in 2007. So more economic value. You also get much more in dividends. At those past peaks, you were buying into dividend yields of 1% and change. Now you're over 2%. And more important, the trend is higher. We have a record number of companies increasing dividends. Most companies are paying since 1999, and they're only paying a third of their earnings as dividends. So the historic average is over 50%. So there's room for those payments to continue to rise. So companies are using less leverage. Leverage is about half what it was relative to core earnings.
And that's what killed the banks.
Right now versus the prior peak. So you could have a stumble in the economy, and it's not necessarily going to drive company profitability into the ground like it did in the past. The alternatives are worse, right? In 2007, you could buy a 10-year treasury at over 4%, and in 2000, you can get more than 6%. You're getting 1.7% now. So if you're running from the stock market, I would question, where are you running to? If you know something I don't, please tell me, because I'm on the
gold.
I'm on the hunt for decent yields. And lastly, just keep in mind inflation. It's been muted the past several years, but consumer prices are up 11% since the last stock market peak in 2007. So you'd have to say, if the stock market is merely even now with what it was then, in after inflation terms, we really haven't set a new high. So some things are different. I'm not saying you should be an extreme bull right now, but you don't want to run from this market. Look for the pockets of value that still remain in the market.
All right, Jack Hough, Barron's, good stuff. Thank you very much.